Good afternoon. This is Anna Pinedo, and I'm joined this afternoon by my partners, Eddie Best, Tom Humphreys, and Remote Riegersman, and we're going to be talking about liability management transactions. Before we begin, I'd like to cover a few housekeeping items. So to ask questions, you'll see at the bottom of your screen, toward the left-hand side, there's a Q&A widget. If you type in your questions, we will try during the course of the presentation to respond to those questions, or if we run out of time during the presentation, then we'll respond to you directly by email. If you're listening today for CLE credit, there's CLE credit available for the live version of the presentation, and in order to get CLE credit, we ask that you download both the affirmation form and the evaluation form. You can find the two forms in the resources widget on your screen, and then during the presentation about halfway through, we'll announce the CLE code. So you need to make note of that and include that on the forms when you send them back to us. Also, if the slides are difficult to read on screen, you can download the slides from the resources widget, and you can also download the supplemental materials that we included on the resources widget, and those include some helpful materials, charts, and summaries on liability management transactions. We're also going to distribute by email after the webcast is concluded today a copy of the presentation and a copy of the supplemental materials. So with that, I'm going to get us started today and talk a little bit about what we hope to cover today. So obviously, liability management transactions are an important tool in the capital markets toolkit in any kind of market environment. They're particularly important when there are periods of market volatility, and that market volatility affects both the equity and the debt markets. There may be specific reasons or specific benefits associated with undertaking repurchases or exchanges of debt securities, and these may be in part motivated by perception, the perception that the company believes, for example, that its debt is trading at a significant discount. During periods like this, many companies are focused on deleveraging and want to make sure that they stay well within the bounds of any financial covenants that they may have imposed by bank lines, other credit facilities, note covenants, and so on. So that's another consideration. To the extent that a company is taking out debt that is trading at a discount, it may be possible in certain circumstances to result in or record an accounting gain. So that may well motivate a number of companies. Likewise, there may be potential EPS improvement depending on the structure of the balance sheet. For some companies, they may be principally motivated by regulatory or ratings benefits. So for some companies, having tangible equity is very significant from the perspective of their principal regulators. And then, of course, this may be a prelude to a more fundamental recapitalization or restructuring transaction, or for companies in certain sectors to a potential bankruptcy. During the course of today's presentation, we're going to focus principally on transactions that are opportunistic and that don't involve companies that are in severe financial distress and contemplating a bankruptcy. Our bankruptcy and restructuring colleagues will join us for future sessions on transactions that can be done when a company is approaching those milestones. So in terms of how a company might consider or might think about a liability management transaction. Often, for ease, Eddie and I on the capital market side tend to think of a range of transactions as existing on a bit of a continuum. From those transactions that are easiest to execute and that may well be contemplated by the terms of the securities that are outstanding, or transactions that can be executed with relatively little advanced preparation, to, as you'll see on the far right, transactions that are highly structured, including registered exchange offers, or more bespoke exchange offers, including debt for equity swaps or equity for equity exchange. So we've arranged our presentation to sort of follow this continuum of transaction options. It's also helpful to consider whether a company that is thinking about a liability management transaction has cash on hand and determines, or with its board determines, that this is a prudent use of cash. If it has cash on hand, then it might well consider redemptions, open market or privately negotiated repurchases, or tender offers. Of course, cash may be a very valuable commodity, and a company might not want to use its cash in this way, and so it might consider alternatives that we're going to discuss today where there's non-cash consideration. So exchange offers and consent solicitations where, although there might be a consent fee, it's usually a relatively modest fee. So choosing among these various alternatives is going to be very dependent on the issuer's objectives, and that's a very facts and circumstances specific discussion, and of course on the issuer's financial condition, as I alluded to, as well as the other objectives that may be relevant to the liability management exercise. In terms of thinking about and choosing among the alternatives that we're going to walk through today, it's important to be well informed about the company's credit facilities, because oftentimes these may contain limitations on prepayments and may require that if a company is going to take out certain debt, it pays down any drawn down portions of its facility. There may be more senior securities that have contractual restrictions, and some of those might also require that if new securities are issued, such as in an exchange offer, that the company consider its capital stack. So all of these considerations are highly relevant. So moving right along, a company might consider a redemption. This is just following the terms of its outstanding debt securities and following the conditions that are outlined in the relevant indenture for undertaking a redemption. The indenture typically is going to specify the redemption price as well as the redemption mechanics, and may in certain cases provide for a make-whole type of arrangement for the securities. When an issuer is contemplating a redemption, it also should be taking into account the securities laws and the anti-fraud provisions, and making sure that there's a level playing field in terms of communicating the information to the public. And we've seen in prior periods, and this harkens back to the financial crisis, that the SEC has been very attentive to issues where redemption notices were conveyed only to the affected class and not broadly, and there were Reg FD issues raised by that. So with that, I'm going to hand things off to Eddie to talk about debt repurchases.
Hi, this is Eddie Best. Where a bond indenture does not permit the bonds to be redeemed, or redemption price isn't attractive to the issuer, an issuer may instead look to repurchase the bonds in the open market. A repurchase can be effected in a number of ways. The issuer may negotiate the purchase price directly with the holder. The primary limitation of this method is that the issuer must know who the holder is, which isn't always the case. The issuer can also engage a financial intermediary to negotiate and effect open market repurchases. Often, the original underwriter of the bonds has a good sense of who holds the bonds since they knew who the initial purchasers were, and often make a market in the bonds. The third way is that the issuer can also agree with a financial intermediary to repurchase debt securities that the financial intermediary purchases on a principal basis, which may be through market making or otherwise. Direct or open market purchases have a number of advantages over redemption or other forms of repurchase. First, they give the issuer the ability to negotiate different purchase prices to take advantage of fluctuating market prices or differing circumstances. Second, these repurchases can be an efficient means of refinancing because it requires little preparation, limited or no documentation, and modest transaction costs. For example, an issuer could thus fund the repurchase either with available cash, commercial paper borrowings, or credit lines, and then term out the borrowings or replenish its cash at a more opportune time. This is also particularly effective if the issuer is seeking to repurchase only a small percentage of its outstanding debt, or if the debt is not widely held. This obviously would not work as well where the issuer is looking to acquire a significant amount of its bonds or to acquire the bonds quickly. Another downside to repurchases is where the issuer has material non-public information in its possession. Where an issuer could redeem the bonds while it has material non-public information under some circumstances, it certainly cannot repurchase securities from an individual or in the market where it has material non-public information. Where an issuer decides to repurchase its debt securities in privately negotiated transactions or in open market purchases, it must make sure to not inadvertently trigger the SEC's tender offer rules. The tender offer rules were adopted to ensure that issuers and others conducting tenders for equity securities would be prohibited from engaging in manipulative practices. While most of the SEC's tender offer rules apply to tender offers for registered equity securities, which would include convertible debt securities, a few of those rules also apply to tender offers for non-convertible debt securities. The two most important rules that apply to non-convertible debt tenders are the timing requirements, meaning the tender offer must remain open for a certain period of time, and the anti-fraud requirements. Of course, the SEC would not want to make things easy on us, so there is no statutory or regulatory definition of a tender offer. Rather, courts apply what has become known as the Wellman 8-factor test to determine whether a repurchase is a tender offer. To be clear, a transaction does not need to meet all 8 of these factors to constitute a tender offer, nor does the absence of any single factor necessarily negate the presence of a tender offer. The 8 factors are as follows. 1. Active and widespread solicitation of public shareholders for the shares. This obviously would not be present for one-off transactions. The offer to purchase is made at a premium over the prevailing market price. The terms of the offer are firm rather than negotiable. The offer is contingent on the tender of a fixed number of shares or bonds, often subject to a fixed maximum number to be purchased. The offer is open only for a limited period of time. The offeree is subject to pressure to sell his or her stock. And lastly, a public announcement of a purchasing program concerning the target company precedes or accompanies rapid accumulation of a large amount of stock. Thus, to avoid repurchase programs triggering the SEC's tender offer rules, they should be structured for a limited amount of securities, to a limited number of holders, preferably sophisticated investors. The purchases should take place over an extended period of time with no pressure for holders to sell. The prices should be privately and individually negotiated with offers and acceptances independent of one another. Just as with redemptions discussed above, private transaction or open market purchase programs with creditor or debt holders can trigger disclosure obligations under SEC Regulation Fair Disclosure, or Reg FD, and have other disclosure implications. The existence of the repurchases or the repurchase program itself could be material information, for example, where it is part of a larger financial restructuring. Regulation FD could also be implicated where an issuer discloses material non-public information to market professionals or holders of its securities who may trade on the basis of that information. For example, in one-on-one discussions, a bondholder may ask the company for projections or other non-public information before deciding whether or not to sell its bonds. Of course, Regulation FD concerns can be avoided if the bondholder signs a confidentiality agreement, though that is obviously much harder to do in open market purchase programs. The other disclosure concern is where the issuer has material non-public information. For example, unreleased earnings or potential changes to credit ratings. In these cases, the issuer will likely have to release the information prior to engaging in any repurchases. One other thing to think about is that repurchases of convertible debt securities may trigger Regulation M concerns. Rule 102 of SEC Regulation M makes it unlawful for an issuer to bid for, purchase, or attempt to induce any person to bid for or purchase a covered security during the applicable restricted period. Repurchases of convertible debt may be deemed a forced conversion and thus a distribution of the underlying equity security covered by Regulation M. Now we're going to turn to debt tenders, and I'll keep going. Where an issuer has decided to engage in a tender offer, it must comply with the SEC's tender offer rules. Under the tender offer rules, convertible or exchangeable debt securities are treated like equity securities, subject to the rules applicable to equity tender offers, meaning Rule 13E4. That's where those rules govern issuer tender offers. The SEC's tender offer rules include the following provisions. The issuer must file with the SEC a Schedule TO. That Schedule TO is subject to SEC review. There's the all holder rule, which says that offers must be made to all holders. The best price rule says that the consideration paid to any holder for securities tendered must be the highest consideration paid to any other holder for securities tendered. We'll talk about that more in a minute. The tender must be announced, usually via Wall Street Journal publication. The tender must include withdrawal rights for the offer period. Securities may be withdrawn after 40 business days from commencement. And finally, the issuer may not make any purchases until 10 days after the termination of the tender offer, other than through the tender offer itself. The following are a few things to consider when tendering for convertible debt securities. In many, if not most, straight tenders, the issuer will include an early tender fee payable at the end of the 10th day. This encourages holders to tender early and also allows the issuer to then do a financing during the next 10 days if it needs to. Because some holders would get a premium that others do not, this would violate the best price rule I just mentioned, and thus it is not allowed in tender offers for equity securities or convertible debt securities. Issuers should also consult their accountants as to the accounting implications of a tender offer for convertible securities. For example, if the issuer took the position that it intended to settle the convertible securities with stock and thus accounted for the convertible securities in one fashion, tendering for them in cash could require the issuer to change the accounting treatment on its balance sheet. Many issuers of convertible notes enter into related derivative transactions, namely called call spread or capped call transactions, concurrently with the issuance of convertible notes. These transactions can have the effect, from the issuer's perspective, of effectively increasing the conversion rate of the convertible notes and can, in certain circumstances, have tax benefits. Any issuer who has entered into such a transaction should confirm that a tender offer would not allow the counterparty to revise the terms of the transaction or change the economics or tax treatment it's expecting. As noted above, a tender for convertible debt may be deemed a forced conversion and result in a distribution of the underlying equity for Regulation M purposes. Now we're going to talk about tenders for straight debt securities. All tender offers, including tenders for straight debt securities, meaning non-convertible, are subject to SEC Regulation 14E and Rules 14E1, 14E2, and 14E3 thereunder, but not the additional requirements applicable to equity securities discussed above, like the all holders rule or the best price rule. Regulation 14E generally provides that a tender offer must generally be held open for 20 business days, and it has to be extended for 10 days if the amount of securities changes by more than 2% or the consideration or dealer manager's fee increases, and any extension must be announced via press release the day after scheduled expiration and has to include the number of securities tendered. As we're going to discuss in a little bit, notwithstanding the 20 business day rule, a common term in investment grade tender offers is to include an early tender premium after 10 days. And some investment-grade tender offers even include early settlement of the tender after the early tender period. In practice, all bondholders tender during the first 10 days as they want the premium, though the offer technically stays open for 20 full days. We'll discuss exceptions to the 20 business day rule later on in the program. Importantly, Regulation 14E does not require filing of tender offer documents. We're going to talk about investment-grade versus non-investment-grade debt. Historically, tenders of investment-grade debt have been viewed differently by the SEC than those for non-investment-grade debt. For example, prior to recent no-action letter guidance, there were important distinctions between investment-grade and non-investment-grade. Based on no-action letters from more than 30 years ago, investment-grade debt tender offers were not subject to the 10 and 20 business day requirement, but could be done on a more accelerated time schedule. Issuers of investment-grade debt were able to price tender offers based on a fixed spread or even real-time fixed spread over benchmark security. Hybrids and trust preferred securities are generally considered investment-grade debt, notwithstanding the fact that they may actually be called preferred securities and may have some equity attributes to them. The SEC staff guidance relating to tender offers for non-convertible debt securities developed through no-action letters and also through more informal interactions. In January 2015, the SEC staff issued no-action letter guidance applicable to tender offers for non-convertible debt that provides for an abbreviated process for investment-grade and non-investment-grade debt, provided the transaction meets certain conditions. The 2015 abbreviated tender offer process will not be available in every debt tender or to every issuer, and as a result, it remains important to understand the prior rules and the prior SEC no-action guidance. Following the issuance of the 2015 no-action letter, both investment-grade and non-investment-grade tenders, which cannot be conducted in reliance on the relief, will be subject to the prior rules. Historically, as I mentioned before, tenders for non-investment-grade debt were not subject to the 20 business day rule, or the 10 business day exception, if they met the following requirements. Number one, the offers to purchase were made for any and all of the debt securities of a particular series, so in some sense that's a bit like the all holders rule. The offer was open to all record and beneficial holders, so that's the actual all holders rule. The offer was conducted to afford all record and beneficial holders a reasonable opportunity to participate, including expedited dissemination if the offer is open for fewer than 10 days, and practically it never went much below 7 days. The way most people disseminated was through PDFs being sent through DTC and also making them available through a press release, and you could call the information agent. And finally, the tender was not being made in anticipation of or in response to other tender offers for the issuer securities. As I mentioned above, this was the general guidance that was in place until the 2015 rule change. Again, as I mentioned above, tender offers for investment-grade debt could be priced in a number of ways. It could be a fixed price. In other words, we'll pay you 101 or 102 for your bonds. It could also be done as a fixed spread tender. In a fixed spread tender, the price is priced on each day during the offer period by reference to a fixed spread over the then current yield of a specified benchmark U.S. Treasury, determined on the date or as of a date preceding the date of the tender. The offer provided that the information about the benchmark security would be reported in a daily newspaper of national circulation, which was typically the Wall Street Journal. The offer also provided that tendering holders would be paid promptly. It typically also provided that you could call the dealer-manager agreement to get the daily pricing. Finally, we're going to talk about real-time fixed spread. Tenders for investment-grade debt could also be priced using real-time fixed spreads. In that case, the price for the tender offer was based on a reference to a stated fixed spread over the most current yield on a benchmark U.S. Treasury, determined at the time the holder tenders, as opposed to a fixed date, rather than by reference to the particular date. In that case, the offer had to clearly indicate the benchmark U.S. Treasury, which was typically on the front page of the offer to purchase, state the nominal purchase price that would have been payable on the applicable yield, so people could run their own calculations, indicate the reference source to be used to establish the benchmark, so that people could then go look that up. Describe the methodology used to calculate the purchase price, which, to be perfectly honest, as a corporate lawyer, I've read a million times, but still have to have bankers walk me through it. And then finally, indicate that the current benchmark and the resulting purchase price would be available by calling a toll-free number. So those are two different ways in which investment-grade debt transactions could be priced. And finally, we're going to talk about investment-grade versus non-investment-grade debt pre-abbreviated tender offer no action relief. As I mentioned above, investment-grade debt was generally open 7 to 10 calendar days, so a little bit shorter. The offer could be extended by 5 calendar days based on for certain modifications of the terms. It had to be conducted to afford everybody the opportunity to participate and to get the documents quickly, and you could use a fixed spread or a real-time fixed spread. On the other hand, non-investment grade or high-yield debt had to remain open for 20 business days. Though, as I mentioned before, you could have an early tender period. The offer had to be extended for 10 business days, and you did have the ability to use a fixed price spread, the way you could in an investment grade, but you had to set the fixed price spread 2 days before the expiration of the offer in order to give people the opportunity to know what that was, and if they wanted to, they could either withdraw if they hadn't tendered, or they could tender if they hadn't already tendered. And with that, I'm going to turn it over to Anna to talk about the abbreviated tender offer rules.
Okay, thanks, Eddie. So as Eddie mentioned, as a result of a multi-firm effort, the SEC staff issued a no-action letter in 2015, and then a little bit over a year later came out with some compliance and disclosure interpretations that provided a little bit more detail and guidance with respect to certain aspects of the no-action letter, and in particular the conditions. So essentially, what the no-action letter provides are certain factual circumstances or conditions that, if the issuer complies, would allow an issuer to conduct a tender offer for any or all of a class of its non-convertible debt securities in 5 business days instead of the 20 business days that Eddie was describing. And as Eddie mentioned, this letter applies both to investment grade and non-investment grade debt securities. And unless an issuer is unable to meet the conditions for the relief, it supersedes that prior 20 to 30 years of no-action letter guidance on expedited tenders and exchanges for investment-grade debt securities. So it's very useful. In most cases, we'll see that there's some rigidity relating to some of the conditions. So as I mentioned, the relief is available only for eligible transactions, and so it has to relate to a class of non-convertible debt securities. So if you're dealing with a convert, then we fall back to the prior guidance. There is no ratings criteria, so it can be investment grade, it could be high yield debt. It doesn't apply to third-party tenders, so the offer has to be made by the issuer of the securities. I guess it could also be made by a wholly owned subsidiary or by a parent company of the issuer. It has to be for any and all securities of the class, and then the consideration for the offer has to consist only of cash or qualified debt securities, or a combination of cash and qualified debt securities. And what we mean by qualified debt securities in this context are non-convertible debt securities that are identical in all material respects to the debt securities that are being tendered for, except for the basic money terms, so maturity date, interest payment record date, the redemption provisions, and so on. Have to have interest that's payable only in cash and a weighted average life to maturity that's no longer than the debt securities that are the subject of the offer. So to the extent that you're thinking about maturity cliffs, this may not necessarily be as helpful. There can't be any financing with debt that's senior to the debt that's being tendered for. So senior debt can't be used to finance the offer, and that excludes debt that may already be outstanding. So let's say, for example, you're a company that has a credit facility, a secured credit facility, and it's outstanding. You've drawn down on it. It's outstanding before the time that you go ahead and decide to take this tender offer up. That would be fine. Of course, in terms of looking at what is senior, you would look at the obligors, the guarantors. You would look at the collateral. You would look at whether it's senior in right of payment in all other respects. It has to be open, as we note on the slide, to all record and beneficial owners of the targeted debt securities, although you could restrict it for purposes of ensuring, for example, that you don't need to comply with the rules and regulations regarding tenders in various EU jurisdictions. You could restrict it to quibs or in other ways. There are certain very specific requirements relating to announcements. So you have to make sure that there's immediate and widespread dissemination of the offer. So these rules are much more prescriptive than what Eddie described previously for as far as the typical approach for tender offers where notice was given to DTC. So in this instance, the offer has to be announced through a press release. That has to be made before 10 Eastern. It has to be made on the first business day of that 5 business day period. And it has to be made through a wire service. So very different from just mailing the offer documents before the clock strikes midnight. In terms of the disclosures that have to be included in that notification, you have to mention the basic terms of the offer, and you have to have a hyperlink that would allow a holder then to get copies of the offer to purchase and a letter of transmittal if you're using a letter of transmittal. And then in addition to that, if the issuer is a public company, then you also have to file a Form 8K before 12 noon on the first business day, and that has to attach to it the press release that I just mentioned. In addition, Eddie talked a little bit about this concept of benchmark pricing. So the consideration can be fixed, or it could be an amount that's based on a fixed spread to a benchmark. And for qualified debt securities, the coupon can be based on a spread to benchmark. So that's allowed. The spread that's used has to be announced at the commencement of the tender offer. And the exact amount of consideration and the interest rate has to be fixed by no later than 2 p.m. Eastern on the last business day of the offer. In terms of withdrawal rights, the offer has to provide for withdrawal rights that are exercisable until at least the earlier of the expiration date of the offer, or if you extend the offer, then the 10th business day after you commence the offer, and at any time after the 60th business day following commencement if for any reason the offer weren't completed by then. In terms of early settlement, again, unlike some of the discussion that Eddie outlined earlier, the offer has to provide that consideration is not going to be paid until after the expiration of the offer. So no early settlement feature. Some big differences. To the extent that there are changes to the offer. So the offer has to be extended for at least 5 business days from and after, including an announcement of a change in consideration, and alternatively for at least 3 business days if there's another material change in the offer terms. There are a number of instances in which this expedited process just is not available. There are a number of cases in which there are disqualifying events and an issuer is going to be limited and prevented from using this, and alternatively has to fall back to the guidance that Eddie talked about. So, for example, this can't be used in the context of where you're soliciting an exit consent. So if you're trying to amend the provisions of an indenture and get out from under indenture provisions, you can't use this. Similarly, if you're the subject of bankruptcy or you've commenced an out-of-court restructuring or contemplating something similar, this is not going to be available to you. So it's important to consider the disqualifying events, and likewise important to consider whether this type of relief provides the flexibility that you as an issuer might need in this context, or whether it makes sense to revert to the guidance, the historic guidance that is a little bit more flexible, at least in allowing for consent solicitations. So I'm going to pause here. I'm going to read the CLE code. As I mentioned, if you download from the resources widget the 2 forms for today's live presentation, include in those today's CLE code, which is 03, M for mayor, B for boy, 30, L for liability, M for management. So 03MB30LM. So continuing right along, as I mentioned at the outset, it may be the case that a company doesn't have cash and instead would like to address its liabilities and undertake an exchange offer. That's another option, and in this environment, it may be an important option in terms of allowing the company maybe to reduce its interest rate burden or accomplish other financial goals. So an exchange offer could be conducted on an SEC registered basis or on an exempt basis. Conducting a private exchange offer under Section 482, the statutory private placement exemption, is a relatively easy process if you rely on pre-certifications, making certain that the offer is made available only to holders that have certified that they are qualified institutional buyers or institutional accredited investors. In a private exchange, again, you might be able to conduct this on an abbreviated basis, where after certifying the status of the holders and announcing the exchange, you distribute exchange information, which, since the transaction is private, isn't required to be filed with the SEC. You might engage the services of a dealer manager, an investment bank, to assist with this process, and after keeping the offer open for a period of time, then close and announce the results of the exchange offer. Another exempt alternative is a Section 3A9 exchange offer. So the exemptions available in the case of securities that are exchanged by an issuer where there is no commission or paid to a third party. So you can have a solicitation agent or an information agent that isn't getting paid transaction-based compensation, and where the only consideration to exchanging holders or other securities of the same issuer. There's a lot of history and lots of no-action letter guidance regarding who constitutes or what types of entities constitute the same issuer. And so that bears close consideration. As I mentioned, while it's very helpful in the context of a tender and an exchange offer, and sometimes absolutely necessary to have a dealer manager, particularly to explain the benefits of the transaction to existing holders, in a 3A9, financial intermediary is limited in the types of activities that it can conduct and is going to have to work closely with the company in any outreach to existing holders, and will be limited in terms of performing certain ministerial activities. Finally, of course, an issuer could also conduct a registered exchange offer where it registers the exchange with the SEC on a registration statement on Form S-4, and that may be subject to SEC review. Commencement doesn't start until the registration statement is cleared with the SEC. And in this case as well, you would have a dealer manager. The dealer manager would have liability since new securities are being issued in the context of an exchange offer. So with that, I'm going to hand it off back to Eddie for a brief discussion of consent solicitations before we tackle tax.
Thanks, Anna. We're going to get a little bit technical here because we're going to be talking about the Trust Indenture Act of 1939 and a little bit about trust indentures, but we'll try to get through this together. So we've talked about repurchases of securities or exchanges of securities. Now we're going to talk about a consent solicitation, and a consent solicitation is essentially a request by bondholders to provide a consent to amend the terms of the indenture or the underlying notes. So the first question, of course, is why would somebody want to do that? It's much less common in the investment grade world because most investment grade bond indentures are what are called covenant light, meaning they have relatively few covenants. Although a number of years ago, as a result of a case, I'd say maybe infamous rather than famous, there were an awful lot of tender offer, a lot of consent solicitations rather, being done for investment grade transactions. Mostly this is done in the high yield area because obviously high yield bonds and high yield bond indentures have a lot more covenants. So the question would be, why would an issuer want to do a consent solicitation? The first one would be to amend, obviously, the restrictive covenants. That could either be to allow a potential transaction. So, for example, the issuer may be doing a large acquisition, and either the acquisition itself could be limited, the ability to incur debt could be limited, or something else like that. It could also be that the issuer isn't meeting one of its bond covenants and needs to amend that. It could also do it after an acquisition, for example, where an issuer acquires another company and the other company has an awful lot of high yield covenants, but now the new acquirer, the new parent, is an investment grade company, puts on a guarantee and says, gee, now that these are guaranteed, they're investment grade, I'd like to get rid of some of the covenants, or I'd like to get rid of some of the reporting covenants. So there are a number of different reasons why an issuer might want to do that. Also, by the way, if the indenture is a secured indenture, there might be some release of collateral issues in there. Okay, so a consent solicitation can be done on its own, where you just go out. It's a very simple document. You ask people to consent. You explain what the transaction is, what the consent you're looking for, or it could be coupled with a tender offer or an exchange offer. So when you're going to start a consent solicitation, you're trying to decide what you're going to do. First question is what you're doing permitted under the terms of the governing indenture? Indentures are governed by the Trust Indenture Act of 1939, and the TIA says that you can't amend an indenture or have a provision that reduces the principal or interest, amends the maturity date, changes the form of payment, or makes other significant economic changes unless the amendment is consented to by all the holders. That makes a lot of sense. I can't have 51% of the bondholders agree that we're going to cut the principal in half or change the interest rate. So the first question is it required? And what is the percentage of the holders that you need to do something? Some indentures provide it's a simple majority. Some indentures provide that it's 2/3. Sometimes it's something different. And then lastly, and this is a 1933 Act concern, if you change the security in a fundamental way that the SEC may deem that to be the issuance of a new security. So, for example, if you change the interest rate significantly, if you change the amount of principal that's being issued, if you change the maturity date, the SEC might take the view that the consent solicitation, that the new bonds that after the amendment are so radically different and structurally different than the original bonds that you've asked people to make a new investment decision, and therefore you've got to think through whether the offer that you're making, arguably, is a public offering or whether there's an exemption. So depending on what you're doing, you have to think through that. Okay, next slide. So if I'm holding a bond and the issuer comes to me and says, "Hey, I'd like you to agree to an amendment," oftentimes the holder would say, "Well, gee, that's nice, but why would I agree to that? That's not necessarily in my favor, right? Because I'm going to still hold this security afterwards." And so one way that you can do that, obviously, is you can offer to pay for the consent. In some situations, the amendment that you're going to make is actually favorable to the holder. So, for example, a company that's going to do a large acquisition that is going to really transform the company and be accretive and be helpful and do all sorts of other things, a bondholder might look at that and say, "Wow, that's great. Okay, that's in my best interest, so therefore I'm going to do that myself." But I will tell you, having talked to liability management people over the years, even where you're doing a consent solicitation that's in the best interest of the stockholder, of the bondholders, they still may not look at it. They still may not pay any attention to it. So you still may have to pay them a fee, frankly, just for the inconvenience of making them open up the document and look at it. Okay, so if you're worried that the holder isn't going to agree to something because maybe it's adverse to them, then you can actually have an exit consent where you do a tender offer or exchange offer. You go to the bondholders and you say, "I'd like your consent to this." So, for example, "I'd like your consent to strip out all of the covenants," right? No holder would ever agree to that if they're going to continue to hold the bonds, but you say, "I'm going to tender for the security, so I'll buy your security. You'll give me a consent that will be voted immediately prior to the end of the tender offer." And that way, when all is said and done, anybody that hasn't tendered will be left with a security with no covenants in it. So yes, it's highly coercive, but on the other hand, it's actually very effective, because if you're a holder, you would look at that and you'd say, "Well, I'd rather tender my bond, give my consent to get out, because I don't want to be the last 3%, 5%, 10% that's left with a bond with no covenants in it." So that's why oftentimes people would have exit consents as part of a tender offer. Now, we also mentioned on the slide that consent solicitations are typically held open for 10 business days. We mentioned before, tender offers are typically held open for 20 business days, unless you could do an abbreviated or a shorter form. One of the reasons that they're held open for a short period of time is, frankly, you don't want the bondholders to kind of start calling other bondholders and forming a group, because if they can form a group that holds a large enough percentage of the bonds, they may then be able to either keep you from getting your consent or hold out for a larger consent payment. So typically you would hold it open for a relatively short period of time. 10 days is usual, but sometimes it's even a little bit shorter. And then if you need to, you can certainly extend it. So that's why it's 10 days. Okay, so I'm going to try to gloss over fairly quickly and then turn you over to the tax folks. The Marblegate case came out a few years ago. The question there was this provision of the TIA before that I mentioned. There are a number of provisions of the TIA that are mandatory. Your indenture has to have it. And they wanted to amend the indenture in a way that a number of bondholders said wasn't in their best interests. And moving on to the next page, what you'll see is the district court held that there's a provision of the Trust Indenture Act that said the right of a holder of an indenture to receive payment can't be infringed can't be impaired without the consent of the holder. In this case, the consent that was being asked for, the court said, "Gee, this is going to make the bonds you own less likely to be paid, and therefore it violates the Trust Indenture Act." Luckily, and then there was, you'll see there was another case that was relatively similar. Luckily, the Second Circuit said, "Wait a second, that's not what the TIA says." And I should mention again, it's the Trust Indenture Act of 1939, so it's been around for close to 80 years, and in that time period, I'll bet the first 65 years there was never a case under it, and there have been a couple of series of cases. It's not a very well-known or often litigated act. But you'll see here that the Second Circuit finally came to its senses and said, wait a second, there's a difference between the legal right to payment and the likelihood that you're going to be paid. So it's one thing to change your right to be paid, which the consent solicitation didn't do, but that's not the same as the likelihood that you're going to be paid. And so luckily the Second Circuit now, I think, and where we've got everything, is the right to be paid, meaning the legal right to sue or to be paid, can't be impaired. On the other hand, even if you do a consent solicitation that makes it less likely, that doesn't implicate the Trust Indenture Act. And with that, I'm going to turn it over to my tax colleagues.
Okay, Eddie, thanks very much. This is Tom Humphreys. And with me, my partner, Remelt Reigersman. The tax considerations here are, in tender offers and all, can be incredibly complicated. But I think what we would like to do in the period of time we have left, and we might go a little over, is just talk about some basic things that you need to know, you need to flag when it comes to the tax consequences of tender offers, exchange offers, and things like that. So you've got kind of basic issuer considerations and holder considerations. So the issuer consideration, and when we're dealing in a distressed environment, and that looks like what we are in or going to be in for a bit, what you're really focused on is something called cancellation of indebtedness income. And so for an issuer, so let's say a corporate issuer of bonds that sees that the bonds are trading at distressed prices and wants to go out and buy them up, well, that can trigger cancellation of indebtedness income, and that's taxable income for that issuer. So there are exceptions. In many cases, there are bankruptcy exceptions or other exceptions, but the exceptions many times will allow you to escape cancellation of indebtedness income. But in certain cases, there is no escape. Now, the other thing to say about COD is that if you are in a distressed situation, many times you can recognize a tremendous amount of COD, and the client won't really care. And that's because there is a substantial operating loss in the same year or other attributes. All right. The other consideration that we see in distressed environments is the HIDO rules, high yield debt obligation rules. And so what those are rules that if you issue a new debt instrument and it has a term more than 5 years and it has a yield to maturity that is greater than the applicable federal rate plus 5%, and it has something called significant OID, then the deductions on that instrument, what you thought were these great OID deductions you could get, will actually be deferred until payment, in certain cases disallowed. Now, and when you look at what the applicable federal rate is today, which is 99 basis points, a 6% debt instrument, so 5 plus 1%, 6%, in this environment, a new debt instrument would not be all that unusual. So you have to be very, very careful about those rules. Now, if you're in the lucky situation of buying back debt at a premium, then that premium is going to be a deduction for federal income tax purposes. For convertible bonds, it's only a deduction to the extent of a reasonable premium, and so you can't buy a hugely appreciated convert back and deduct that entire purchase price. Now, in the next slide, you see there the basic rule: you buy back your debt, you have to recognize ordinary income in the amount of the discount. If you exchange new debt for old debt, then you have to look at a couple of technical terms: adjusted issue price of the old debt and adjusted issue price of the new debt. And if the adjusted issue price of the new debt is lower than that of the old, you're going to have, again, cancellation of indebtedness income. Modifications. So it's not just buying back debt. It's not just exchanging debt. But when you modify your debt, in certain circumstances, that will be an exchange for tax purposes. And then you're going to have to recognize cancellation of indebtedness income. So you see there on the slide a number of different tripwires to figure out whether an exchange is significant. We're not going to go through those, but just remember that even though all you're doing is asking for consent to change the terms of the instrument, that can still trigger taxable consequences for your issuer. And the debt equity swap. So now we've got debt outstanding and the issuer issues equity. We're going to look at the fair market value of the equity against the issue price of the outstanding debt. And again, if that's a discount, then there's going to be cancellation of indebtedness income. Now, the only thing I'll say before I turn it over to Remel, and what we have seen in many situations like this, I have never seen cancellation of indebtedness income stop an issuer from restructuring its debt in a distressed environment. And the reason for that is, as I said earlier, in many cases, the issuers are showing fantastic losses for federal income tax purposes, or substantial losses, shall we say. And so the amount of COD may be pale in comparison. In fact, during the financial crisis, we saw people take $500 million amounts of COD in income without blinking an eye and without really thinking, more than a couple seconds about that tax consequence because things were so bad. Let's hope it doesn't get that bad this time. But with that, I'm going to turn it over to Remel. We're going to talk about considerations for holders and then throw in something on the CARES Act. Remel?
Thanks, Tom. This is Remelt. So on the flip side, on the holder side, the tax consequences typically depend on whether the restructuring constitutes a recap or recapitalization under the tax code. That determination then in turn depends on what the term of the securities are. So and this is relevant for instruments that are debt for tax. This is not provided for in the code or regulations. It's essentially case law, and that case law provides that if the term is longer than 10 years, instruments are typically securities. If they're less than 5 years, typically not securities. Between 5 and 10, it's a little uncertain. I think if you look in the market, typically people take the position instruments are securities between 5 and 10 years. A holder can have gain or loss upon any type of exchange, modification, etc. That's determined by taking the difference between the amount of cash received as cash or the holder's adjusted tax basis. In the debt, typically instruments are held as capital assets, and any gain or loss is capital gain. To the extent of any market discount, which applies to secondary market purchasers, a piece or a portion of the gain can be characterized as ordinary income instead of capital gain. Now, if the exchange is a recap, if it's securities for securities or securities for equity, then by virtue of it being a recapitalization, the holder does not recognize gain or loss. There are a few special rules that I'll highlight where it depends on the facts and circumstances and the terms. For example, if the principal amount of the new debt exceeds the principal amount of the old debt, then the holder could recognize gain. Also gain to the extent of boot, for example, cash or other property that doesn't qualify for tax-free treatment. And to the extent there's an exchange or a modification of old debt, that can also create original issue discount. It can also create premium that's amortizable. And if there's a debt for equity swap that is a recap, then there's no gain or loss. If there's a market discount on the debt that gets then exchanged into equity, that will carry over into the equity piece. Then consent fees. You heard Anna and Eddie talk about that earlier. The question is, what's the tax treatment of consent fees? It's not clear. Typically, issuers will treat it as ordinary income. Sometimes it's disclosed as just a payment of a fee, taxable as a separate fee. There's an issue then to the extent you've got foreign investors or foreign holders of debt instruments who receive a fee, whether that fee is subject to withholding or not. Typically, people don't treat it as subject to withholding, but that's not entirely risk-free. There's a private letter ruling, as you see the number there on the slide, in which the IRS indicated that they would treat the fee or the taxpayer asked for, and the IRS agreed with the treatment in that particular case of treating the fee as first a payment of accrued interest. That's somewhat helpful. It's not entirely helpful in the sense that it's unclear what then happens when the actual accrued interest gets paid later on the payment date, and that was not addressed in the private letter ruling. Before we jump to the CARES Act, I just wanted to mention Eddie talked about call spread convertibles and noted that there are some tax sensitivities around those instruments or those arrangements, and so call spread convertibles have a particular tax angle to it where the cost of the lower strike derivative is in effect deducted for tax purposes, but the income from the higher strike derivative is typically tax-free. And so that is achieved by doing an integration, and that integration has to be close to perfect. And so when there's tinkering or tweaking around the call spread convertible, you just got to be very careful not to mess up the intended tax treatment. So that's an area to keep in touch with the tax lawyers. Then let's briefly talk about the CARES Act. We'll have a few minutes left. So this is obviously the big stimulus bill that the president signed into law. I think it was on Friday. There's a whole bunch of provisions in there. We've got two slides just to touch on some of the tax pieces. NOLs, net operating losses, under the existing law, which is new since 2017. NOLs could no longer be carried back and are somewhat limited in their use being carried forward to only an 80% limitation of income, essentially. And so the CARES Act does away with that for a little bit. Essentially, NOLs generated in 18, 19, and 2020 can be carried back 5 years, and the 80% limitation is removed, but then is reinstated again later. 163J is a provision that limits the deduction of interest expense that was set at 30% of EBITDA, essentially. That is being moved to 50% for tax years beginning in 2019 and 2020. AMT credits, as part of the original Trump tax reform in 2017, corporate AMT, I should say, was eliminated, and AMT credits became refundable over a period of time. That is accelerated, the refunds of those credits. There's an employee retention credit, so certain employers will get a credit against employment taxes. It's equal to $50,000 of wages paid to employees as a result of the COVID-19 outbreak. Then federal loans. So Treasury can make loans to eligible businesses, total earmarked of $500 billion. The businesses have to agree to oversight and limitations on executive compensation, and the government typically would take an equity interest in the business so they can share in the upside. There's some uncertainty on the tax side. If the government takes both debt and equity, whether that creates OID, how the interest is treated, et cetera. And so there's a special provision in the CARES Act that deals with the tax treatment of these loans to make it essentially as plain vanilla and as simple as possible. Small business loans, so it expands the Small Business Act, additional lending to small business. Small business can use that for certain expenses that will result in forgiveness. If you pay for salaries, mortgage, rent, utility payments, then the piece of the loan or the proceeds from the loan used to pay those expenses will be forgiven. And the CARES Act provides that there will not be COD income once that is forgiven. Checks in the mail, you probably read in the news, depending on or subject to certain phase-outs in terms of income. Single filers will get $1,200 and joint filers $2,400 with $500 for each child. And there are some changes to the charitable donations, essentially making it more flexible, allowing higher deductions and reducing some of the limits to taking deductions for charitable donations. So with that, let's see, we've got some last slides on some resources that we have. Liability Management book. We've got client alerts on our website, including all the developments and legislative developments, including the CARES Act that I just mentioned. So we've run over a little bit. We appreciate listening in. If you have any questions, please reach out to us. Thank you very much for joining, and please don't forget to send in your CLE forms for those who would like CLE credit. Thank you very much.